If you looked at your portfolio in the last month, you have probably noticed that it is dropping like a rock, and you have probably noticed that gas prices are spiking pretty heavily right now. It feels like just everything overall is more expensive lately, especially because the Fed is not cutting rates and the Iran war is driving oil prices higher. The market is reacting very quickly to all of this chaos. And honestly, it can feel a little bit like the end of the world. But the truth here is that this is not just random chaos. And today, I am going to break down exactly what is happening with the economy. I want to tell you what it means for your money, your future, and whether you should be buying the dip or hiding under your bed. By the end of this video, I want to make sure you feel confident with what is going on right now so you can optimize your finances while everyone else is losing their minds. Before we jump in, go ahead and comment down below. Are you currently worried about the economy, or are you just staying calm and investing through it? I really want to see where your heads are at right now, because for me, I am still feeling very calm and I am buying every single week. Let us start out by talking about why the stock market is dropping so fast right now. If you look at the S&P 500 as of today, it is about 8.5% down from its all-time highs. This has all happened in about a month, maybe a month and a half, basically once the conflict in Iran kicked off. The first reason the market is dropping is pure geopolitical risk and the massive oil shock that comes with it. Because of this conflict, we have completely disrupted global energy, especially through the Strait of Hormuz. When you see tensions rise near a major shipping choke point, traders are instantly going to price in higher risk and higher costs. Whenever we see higher oil costs, this leads to broad price increases because energy feeds into almost every single sector. Oil is used in way more things than people realize. It is in your plastics, your production, and obviously your transportation. About 20% of global oil moves through that one strait. So any threat there causes immediate volatility to every market on Earth. Investors know that oil is a massive inflation driver, and when energy costs go up, inflation sticks around a lot longer. We saw this in 2022 when inflation really took off, and oil stocks were pretty much the only sector that did well that year. The second reason the stock market is dropping right now is because of Fed policy and the fact that interest rates are a total mystery. If you asked most people 6 months ago what the Fed would do in 2026, they would have said rate cuts are a guarantee, but right now everything is remaining unchanged. And the Fed is in a very weird position. They are keeping rates high because they are staring at sticky inflation and trying to factor in this global uncertainty. This tells us that the Fed is willing to tolerate higher prices for now, but markets hate a lack of clear direction. The stock market loves when the Fed cuts rates because cheap money makes everything grow faster. If you don't know how the Federal Reserve works, let me give you a quick macroeconomic lesson from what I remember in college. Basically, the Fed wants the economy to do well, but they absolutely hate high inflation. If inflation goes up, the Fed increases interest rates to cool things down, specifically through the federal funds rate. That is the rate at which banks loan money to each other. And if that goes up, they pass those higher costs directly to you. The Fed is stuck right now because if inflation picks up badly, they might actually have to increase rates again. Before this, they were slowly cutting rates as inflation went down, but now the market thinks rate cuts might not happen at all this year. That is pushing yields higher and making growth stocks like big tech look a lot less attractive. Even a massive company like Microsoft is trading down about 30% from its all-time highs recently. When U.S. Treasury yields climb, it reflects increased borrowing costs across the entire economy. Investors start demanding more return to compensate for the risk, so they pull money out of stocks and put it into safe bonds. The 10-year yield increases are killing sectors that rely on cheap capital, which is why your favorite tech stocks are getting wrecked. Higher interest rates make future earnings less valuable today, meaning stocks need to be much stronger to justify their price. Now, I want to briefly talk about my fear for what could potentially happen next. I am not trying to fearmonger you guys because I will tell you how to take advantage of this at the end of the video. But my actual fear is that we might be seeing a repeat of the 1970s, which is a nightmare called stagflation. Stagflation is the toxic combination of slow economic growth, high inflation, and high unemployment. In the 1970s, oil price shocks drove up costs while weak productivity and bad policy response basically froze all growth. Real wages fell even as prices for bread and milk rose, which is a total disaster for the average family. We see a couple of parallels today because we have rising energy prices and inflationary pressure that won't go away. We have a Fed that is hesitant to cut rates and consumer sentiment is sliding down a mountain. Inflation continues to grow, but wages are not following that fast enough, making it harder to get by. There is a lot of stock market volatility that feels very similar to that 1970s energy and policy mix. But there are a couple of big differences that we need to acknowledge before we start panic selling everything. The US economy is a lot less dependent on oil today than it was back then, and we are a much bigger oil producer ourselves. Inflation is not at extreme double-digit levels yet, which is why the Fed is being so cautious. Still, if energy stays expensive and the Fed doesn't T-pivot, inflation could become very sticky. Markets hate stagflation because high inflation erodes your real returns on your investments. If you get a 12% return in the market, but inflation is 6%, your real return is only 6%. On top of that, Slow growth means company earnings will stagnate and valuations will shrink. That is why the markets are selling off in response to everything that is happening in the news. So, what can you actually do about this besides complaining about the price of eggs? The first thing I would say is make sure you have a very solid emergency fund of 3 to 6 months of expenses. I know I say this in a lot of videos, but when the economy is uncertain, cash is your best friend. If something goes bad with your job, you don't want to be forced to sell your stocks while the market is down. The next thing is to actually focus on fundamentals and stop reading every single scary headline. Markets are always going to go up and down, and geopolitical tensions always sound worse than they are long-term. A short-term drop does not mean a long-term collapse, and we have to keep our perspective. Last year, the market sold off almost 18% in a month or two, and then it completely bounced back to new highs. The same thing could be happening right now since we are only down about 8.5%. We are not even in a full-on bear market yet. So there is no reason to freak out and sell your vote. I saw a funny picture of Warren Buffett online that said, Don T, just do something, stand there. And it is actually true. Even if the market drops for the next 6 months or 2 years, you just need to focus on your income. If you can keep your job and pay your bills, this is where the massive opportunity actually kicks in. Stay invested, but make sure you are at least somewhat diversified across different sectors. I always invest into index funds like VU for the 500 largest companies or VTI for the total stock market. You can pair those with VXEs for international exposure, so all your eggs are in T in the US basket. If you want to own every stock in the world, you can just buy VT and call it a day. This is not financial advice, but it is a way to make sure you aren't just YOLOing your life savings into one tech stock. Diversification helps you big time because while tech might be struggling, the energy sector is probably booming. We have already seen ExxonMobil and Chevron doing well this year because of the oil situation. Consumer staples and defensive sectors like healthcare usually hold up a lot better in these times too. The beauty of owning ETFs is that you don't even have to think about which sector is winning. You just keep investing consistently and let the index do the work for you. Most everyday people do the exact opposite of what they should. They buy when things are high and sell when things are low. I follow the method of always be buying, no matter what the news says or how red the screen is. I was buying last month, I am buying this month, and I will be buying next month. When you see the market dip like this, it is actually an opportunity to buy the world's best companies at a discount. If you are bullish on the US economy long term, a 10% or 20% drop is just a massive sale. Don't try to time the market perfectly because you will fail. Just keep your automated investments running. I've already maxed out my Roth IRA for the year, and now I am focusing on my brokerage and 401k. This will definitely pay off if you have a long time horizon of 15 or 20 or 30 years. Try to position yourself for inflation by owning real assets like real estate or dividend stocks. Inflation can be hedged indirectly through these assets that actually have pricing power. There is so much opportunity provided in tough times because lower valuations mean better entry points. If you thought VO was a great deal at $600 a share, you should be doing backflips if it hits $500. Your $1,000 investment goes further, you buy more shares, and you own the same 500 massive companies. These corrections reset the market and let long-term investors buy in before the next big rally. I don't stress when the market does bad because I am just lowering my average cost per S-hair. Time is on my side, and I am confident that the world will keep moving forward. We are in a weird environment right now, so let us just call it what it is. We aren't at full stagflation yet, but the risks are definitely higher than they were a few years ago. Geopolitical risk and rising costs will create a lot of volatility and emotional swings in the market. Do not panic and do not make permanent decisions based on temporary emotions. The economy is not collapsing, it is just shifting, and you need to shift your mindset with it. Position yourself wisely, diversify your assets, and keep that emergency fund fully funded. Educate yourself on these conditions so you aren't scared by the next headline you see on your phone. I hope you guys enjoyed this breakdown of what is actually happening with your money right now. If you did, drop a like down below and hit that subscribe button for more deep dives. I will see you in the next one. Stay calm and keep compounding. Peace.